Okay, so welcome everyone, and thanks for joining today's webinar. We're very excited to showcase the partnership between Macrobond and Quant Insight, and to show how combining Macrobond's desktop application with Quant Insight's unique data set can give you a fresh perspective on the current macro trends. Now, before we dive in, a quick heads up on today's agenda. We're going to save the last 10 minutes for a live Q&A. If anything comes to mind during our conversation, feel free to use the Q&A feature, which you can find at the bottom of your screen. Now, just a quick introduction. With Macrobond, it's easy to track key macro trends since charts and analyses update automatically with the latest data. Combine that with Quant Insight's dataset, and you get a fast quantitative view on today's most relevant macro themes. To help us explore all this, I'm joined by Hugh Roberts, who is the head of analytics at Quant Insight, and Jervis Bay, who is an experienced macro PM at O5 Capital, who uses both Macrobond and QI in his investment process. Now, to start things off, Hugh, would you mind giving us a quick overview of Quant Insight and explain what differentiates you from macro analysis that's currently out there?
Thank you for having us, and thank you, Macrobond, for hosting. So Quant Insight's been going for about 8 years now. We've been on Macrobond for a little under a year. And I guess what QI is trying to do is be a bit of a disruptor to the traditional research space, in the sense that macro research really hasn't changed in decades. It's still dominated by subjective opinion. It's still typically delivered in long form writing, 10, 12 page PDFs. And it's left very much to the reader to figure out whether they agree with economist A, who argues that inflation is sticky and the Fed should be holding pat on rates, or economist B, who writes that they're already behind the curve and they should be slashing rates. So it's not necessarily always the most actionable. QI is different, and we're different because we've built a systematic way that maps macro to assets. And what we do at the heart of that is principal components analysis, a proprietary version of PCA. Now, PCA is ideal for this for two main reasons. One, the idea of dimension reduction. So it takes a large universe of related factors and distills it down to the 2 or 3 variables that are really driving and explaining the variance of the asset in question. So that's great for a world like macro, where there are so many factors which are all interdependent. And secondly, it delivers orthogonality, so the independent pattern of association between, say, the S&P and real yields, or between dollar yen and interest rate differentials. So it kind of solves for the age-old problem of simplistic two-factor correlations, which can give kind of misleading impressions. So that's the methodology. And then what we deliver, in essence, is a couple of things. First of all, we can identify whether an asset is in a macro regime or not. So you can see whether it's macro that's driving price action or it's something else, politics, sentiment, positioning. If it is macro, we can identify what the key factors are. So sticking with FX, is the dollar being driven by interest rate differentials, as is normally the case? Or since April, have we moved into a new regime where it's more about capital flows? What's driving price action? We can then distill all the macro factors, including the most important ones, and determine a real-time measure of macro warranted fair value, where the asset should be given overall macro conditions. So we're kind of unique in giving you kind of a real-time macro momentum metric. And then the last thing that we offer, especially for people who are on the search for trade ideas, is obviously there are times when there's a dislocation. There's the QI model value, where an asset should be given aggregate macro conditions. And then there's the real world, where positioning sentiment has taken the actual spot price today. And there often can be dislocations between the two. In our language, that's a fair value gap. When the asset trades above macro conditions, it's rich to macro, that's a positive fair value gap, or it can be a negative fair value gap where the asset in question is lagging. So the FVGs can be used by some people as kind of pipeline of potential trade ideas. So that's the kind of brief overview of the QI value add.
Thank you for that. I think very informative. And I've got this chart pulled up. So I think a good place to start would be with the bond market, which is arguably the biggest puzzle in the markets right now. It feels like there's this constant tug of war. Do you go long duration because of recession fears, or do you short bonds because of deficits, inflation, and questions, especially around the Fed? So I'm curious, what are Quant Insight's models saying on bonds these days? And I'd also like to take this opportunity to introduce Jervis.
Great, thank you, Ted, and thank you, Hugh, Quant Insight and Macrobond for having me join this webcast. I'll just mention that I am a very happy customer of both of them. So just looking at this chart, what immediately stands out, which we've marked up with that red arrow going down, is the QI model confidence, i.e., the confidence that QI has in terms of macro variables determining where the two-year yield should be has gone down dramatically. And if we spot the time in which this inflection downward happened, that sort of was around early to middle of July, which actually coincided with President Trump's increasing attacks on the Fed and on Jerome, quote unquote, too late Powell. Following that, he also had the attack on the BLS, culminating in the firing of the BLS head following the disappointing NFP report. So long story short, it seems, just looking at this chart, in that there is some other aspect that is starting to move or drive the two-year yields, and putting the qualitative hat on, that seems to suggest that politics increasingly becoming a driver. And so it's important for, at least for me as a equity and macro investor, to pay increasing attention to what's happening on that front.
And if I could jump in before the next question, actually, Ted, agree 100% with that synopsis. And also, it's even more powerful because it's not just two-year yields. I think we've got some charts, and you can show that it's the same pattern. If you look at five-year notes, it's the same pattern on tens, and it's the same pattern with the long bond. The bottom chart each time shows QI model confidence, how good a job macro is doing at explaining price action. You can see how stable that regime was for months and months and months, until, as Jervis says, we started to get all these kind of political angles coming in. So clearly there's an issue here whereby it looks like politics has become more important. But I would just add that this is one of the things about QI, but we're not an academic ivory tower exercise. We don't get precious about our models. Low model confidence isn't a bad thing. It's indicating regime change. It's Jervis's point about politics over macro. But you still can get value at this point. So I think if we could go to the histogram, please, Ted. Now, what we do, I talked about the kind of main outputs of QI. Because of the orthogonal patterns of association we're picking up, we can measure which factors are more important for any asset at any given time. So the way you look at this chart here is the green bars off to the right are positive drivers, and the red bars off to the left are negative drivers. And the standard unit for QI is a one standard deviation shock each time. So if you look at the positive drivers, first up on the right-hand side, you can see that a one standard deviation shock in copper equates to a 3/4 of a basis point rise in 10-year yields. And then you just look down that list: higher copper prices, stronger Chinese GDP, higher inflation expectations at both the 5-year and 10-year point. That's the zero coupon inflation swap market we're using to get daily measures of the market's best guess on inflation, and US GDP as well. So you can see in a snapshot that it's very much a reflationary dynamic that is underpinning the current regime. So that immediately gives the investor a sense that, right, if you fear that Trump is going to adopt a run it hot policy, and if, of course, if he's successful in kind of overloading the Fed with his own picks, and we get this run it hot scenario, then that's going to push QI model value and 10-year yields higher. So that would be obviously a negative duration bet. But equally, I guess it speaks at the moment to the idea that a lot of people out there are more worried about recession. They see US treasuries, despite deficit fears, despite politicization, they see treasuries as a good recession hedge. And this picture kind of vindicates that at the moment. So it really does isolate what the key drivers of price action is, what's driving the regime today.
So I think that encapsulates the growth and the inflation side of things, but there are certainly plenty of other stories out there about why maybe vigilantes haven't really shown up yet and why yields are still so low. For example, maybe a dovish Fed cuts rates more aggressively or even brings back quantitative easing. So I'm curious, can Quant Insight capture things like that in its models?
Yeah, absolutely. So we gave an, although our process is 100% quantitative, but we did define what constitutes macro, I beg your pardon, on day one. And they thought the variables we've chosen in our models are asset class specific and geographical specific. And we gave a lot of thought to them. And we tried to preempt questions just like that. So we do have a factor that speaks to rate expectations. We use the money market strip, 1 year versus 1 year kind of calendar spread. So the market's best guess on where Fed funds will be over the next 12 to 24 months. And we also have a proxy factor to capture expectations around QE versus QT. And just very quickly on that, we use rate vol. And the logic there is quantitative easing is basically financial repression. It's this big price insensitive buyer of government bonds, mortgage bonds, corporate bonds. So that sits on volatility, particularly in the kind of intermediate part of the rate curve. So we use 1 year, 5 year swaption vol as a nice day-to-day proxy for whether the Fed's expanding the balance sheet, we're in QE, or whether it's we're in a taper tantrum 2013 type style scenario and rate vol spiking. And what you can see here is 10-year Treasury yield sensitivity to those two factors. And you can see they're both very close to zero. At the moment, 10-year yields are not trading off moves in the money market strip. They're not massively moving off the moves in terms of rate vol, the move index, if you like. So this doesn't necessarily mean we're making a call on what those factors are going to do. But it does mean that right here, right now, that 10-year yields are comparatively insensitive to them. That could change, obviously, quickly, and that's what regime shifts and changes in factor leadership are all about. But the point being is that QI has anticipated all the possible drivers of 10-year yields. We have either direct factors or proxy factors that capture that narrative, and at any point in time, we're able to give a perspective on it.
Very interesting. And before we move on from bonds, I'd love just to hand it back over to Jarvis for any final thoughts on the bond market.
Yeah, absolutely. So Hugh mentioned a lot about these macro factor sensitivities, and I think the beauty of Quant Insight is being able to better understand why your portfolio, be it a fixed income portfolio or equity portfolio, is moving the way it is, right? I think that's step one. But another function of QI that I like to use, that if you can pull up the fair value table over here, is being able to put out, in combination with Macrobond, a nice snapshot. So here we have all the government bonds globally, not all, but a large selection of it, and it shows how the yields of these bonds are trading relative to Quant Insight's fair value based on its models. And here it's sort of combining the quantitative approach, the data, the fair values that Quant Insight's spitting out, with my own subjective view of what I think the macro outlook is going to be. So, just very hypothetically, assuming I belong in the camp of say a US-led global recession, and if I'm still of the belief qualitatively or subjectively that bonds are still going to be an effective recession hedge, looking over here, Ted, if you could flip up just a touch. Sorry, flip up on the yeah. So if I were looking for a bond hedge against a global recession, I probably wouldn't be looking in the US, right? If you look at those green bars in the up top on this chart, that sort of indicates that US yields are too low versus the macro determined fair value that QI has calculated for me. On the other hand, Germany, or perhaps even France, although there are questions around France now, but German yields look attractive to me, as right now they screen as being higher than their warranted fair value per QI. So again, it's sort of the combination of your qualitative view combined with the qualitative view that Quant Insight is providing, no pun intended there. And obviously, I wouldn't be trading just simplistically on these numbers alone. The next little item here that kind of stands out is if Ted, if you scroll down again, so sorry, going down to the China section. Yeah, we see like big red bars on China, and that actually indicates that Chinese yields are far too low relative to what Quant Insight models would calculate them to be. And if we recall from an earlier chart that Hugh presented, a big driver of the U.S. 10-year yield is actually Chinese GDP. And part of the story is, if Chinese GDP starts to pick up, Chinese yields would also pick up, and the U.S. 10-year yields would also go up. So that would be good news in terms of allaying the whole recessionary fears that are come ever so on and off, but would then add further ammunition to the inflation hawks, or that risk of yields sort of running away from us at this point. So again, it's a very nice snapshot for me to take a look every once in a while and combine it with my view of how the macro landscape is going to turn out.
I think that covers the bond markets. Let's shift over to equities. And a few months back, it looked like U.S. exceptionalism was fading, but that feels a little bit less clear today. So I'm curious to know what Quant Insight sees for the S&P 500 right now.
Yeah, if we could pull up, I think there's a chart that we've got in here of QI model value for the S&P 500. Yeah, so in this chart, if people focus on the dark blue line primarily, so I mentioned at the outset that every day we're snapping the S&P 500 sensitivity to US growth, Chinese growth, US inflation, credit spreads, the dollar, oil, liquidity metrics, and more. And then we distill all that into a single snapshot of macro warranted fair value. That's recorded point in time, no backward revisions, and that is the time series that underpins the blue line here. So what you can see from this straight away is that actually QI model value for SPOOs actually peaked mid-February time, started to roll over even before we got to the Rose Garden early in April. But then you can see the hit that we took on Liberation Day itself. But you can also see the very sharp V-shaped recovery in the blue line, and macro momentum from early April through to literally the last week has been on a one-way clear uptrend from left to right. So macro has been trending higher. It's been a tailwind for the US equity market. Now, again, focusing on that blue line, you can see that arguably momentum is beginning to wane a little bit as we come into September. We've kind of flatlined a little bit. And that really comes down to, I think, the fact that the main driver of the April, May, June, July rally has been easy financial conditions. It's been tight credit spreads. It's been the low rate vol. It's easy FCIs that have underpinned this rally. And that's really what we're watching at the moment.
I think, Jervis, you would come prepared with two charts that you had created in Macrobond, and I'd love just if you were able, I know we're coming up on time for the Q&A portion, but if you could just speak to the two charts that you use regularly, that would be super helpful for us.
Yeah. So maybe you can flip to the first one. Yep. So this, I'm a big fan of color, so that's why I'm also a big fan of Macrobond. But this colorful chart here essentially shows the macro factor sensitivities of the QQQ ETF to three important, at least what I deem to be important macro drivers. In yellow, we have the US 10-year real rate. In red, we have US 5-year inflation expectations. And in that teal green color, the US dollar. And the beauty of Quant Insight is, as opposed to correlation analysis, Quant Insight is able to quickly identify regime changes. So you can see for most of 2022, the QQQ, the Qs were inversely correlated or had an inverse negative relationship to real rates. And that's why simplistically, they didn't perform very well as real rates started accelerating through most of 2022. Coming into 2023, most expected, most of the market were girding for a recession, and a recession that would likely be driven by a too tight Fed. And lo and behold, what we got was indeed a Fed that was unable to cut. We got inflation that stayed higher for longer. But as we know, 2023 was a phenomenal year for equities. The SPX returned 26%, the NAS returned 55%. And quickly looking at this chart, we can see, why that ended up becoming the case. As we saw here, that very negative relationship of the Qs to the real rates became a quite positive relationship. And the Qs also had a very highly positive relationship to US inflation expectations. So this created a very counterintuitive feeling that pervaded through most of 2023, where higher inflation, higher real rates that used to be viewed as a negative actually flipped to becoming a macro tailwind for most of 2023. And going into the topic du jour right now, this sell America, sell US exceptionalism trade, we can also see the regime changing. In most of 2023, a higher dollar, stronger US dollar actually had a negative relationship to the Qs, and that actually has flipped this year, in which a stronger dollar actually would be a macro tailwind if you were for the Qs. So again, a very simple way to look at how regimes can change over time, and actually allows me to second guess what is some of my commonly held intuitions. Yeah.
And then this last one, a nice view of
so
the different.
So the previous colorful chart shows how regime changes over time. It's important to know, once I have that understanding of where we've come from, it's important to know where we are right now. And here, this chart just has the three main US indices up against the 5 macro variables of the day, if you were. That's the real rate, inflation expects, the potential steepening of the curve, US dollar, and Fed rate expectations, or Fed cut expectations, if you want to call it that. And quickly, what stands out is you look at the Russell, very negative relationship to 5-year inflation expectations, and also very positive relationship to Fed rate expectations, i.e., the higher the likelihood of Fed cuts, the higher the IWM is going to trade. And if you think about what's been happening, especially over August, this sort of makes sense, right? As Trump increasingly piled on the pressure on the Fed and Fed cut expectations started rising, we actually saw the IWM, or the Russell, outperform quite some through the month of August. Yeah, it's a very interesting chart here.
We've covered a lot of ground in a short amount of time. So I think it's only right that we transition into the live Q&A portion of the session. For all of those on the call, we may run just a few minutes over. But with that, and staying on the topic of equities, we have a question directed to Jervis saying, Jervis said he tracks how major indices react to macro factors. And actually, this chart here suggests that small caps are reliant on low inflation rate cut hopes. So how does that look historically?
Yeah, so let's go ahead and see if we can pull up the IWM macro sensitivity to the U.S. inflation expectations, and Ted is showing us right now how easy it is to do that with the partnership between Quant Insight and Macrobond. Right, so we'll give him a couple seconds to pull it up. Right. So looking at this chart now, this again, just to remind folks, this shows the relationship of the IWM, the Russell 2000, to each standard deviation move higher in US 5-year inflation expectations. So right now, you can see it's sharply negative. In fact, it's the most negative it's perhaps ever been. And how this can actually lead to an actionable insight for me as both an equity and a macro investment manager is if we sort of go over to the point in time, it's about July 10th of 2024, where it was sharply negative as well.
Right.
Yeah, July 24
yep.
will be over there. Yep, exactly right. So in July 2024, when we were there, also that was pretty much the most negative sensitivity IWM had to the U.S. inflation expectations. And if you recall, in July we had a very soft June CPI print, and obviously most of the market was expecting a soft print to be beneficial for equities in general. What ended up happening was we saw a massive squeeze leading to an unwind in consensus positions. What I mean by that is the IWM actually ripped strongly to the upside at the expense of both the SPX and the Qs. Again, because coming in, and this is where we have to layer in some of our own subjective thinking and some of the other quantitative knowledge around positioning, technicals, what have you, in conjunction with Quant Insight's work. But Quant Insights, this chart here would suggest that the IWM is at risk of, at significant upside risk. And if that happens in conjunction with, heavily consensus positioning to the short side, we could get very serious and quick, fearsome unwinds of those books, right? So as an equity investor, it helps to then pay attention to where your factor vulnerabilities are, and hence therefore where your macro vulnerabilities are as well. Yeah. So very practical anecdote, if you were.
Great, thank you. Thanks for that, Jervis. We have another question from Mauricio Un. His question is, with regards to the dollar, where are we? Smile or fiscal frown? Are central banks really favoring gold over USD/treasuries?
So I can take that one. We have got a lot of FX models, which sadly we haven't had time to go through in much detail today. So Maurizio, very happy to reach out bilaterally to answer this in a more thorough way. But if the 2-minute view would be, Ted, could we go back to the chart of fair value gaps for global government bonds first up? And what I just wanted to show, because obviously the big debate for macro people at the moment is, where are the bond vigilantes? Okay, they're showing up a little bit in curve shape. They're showing up a little bit in terms of gold. But US treasuries are not arguably reacting to the degree you would have expected. If you look at the right-hand column on this chart, you can see R squared. That's our model confidence. Macro is only explaining 30% of price action of 2-year yields. It's only explaining 24% of 10s. So politics has kind of overtaken the US Treasury market. If you now go to the equivalent table, please, Ted, that does the same but for FX. And what you'll see this time is, if you look down the R squared column on the right this time, you can see, okay, dollar yen is just below our threshold for a macro regime. 65%, by the way, is our threshold. So dollar yen just shy. But every other dollar cross you can see there, every other DM dollar cross there is in a strong macro regime. Macro is doing a very good job of explaining price action. And then if you look at the fair value gaps, with one exception, which is dollar NOK, where the dollar screens as cheap, everywhere else, euro dollar, dollar CAD, Aussie dollar, cable, the dollar is looking on the rich side of our valuation framework. So when I put that together myself, it says to me that treasuries at the moment have been driven more by politics than they are by macro. So if you want to be bearish duration, fine, but you've got to have a strong view that Trump will be able to get Cook out, or will be able to choose the next set of Fed governors. Whereas in FX, you've got a clear macro dynamic at work. And at the moment, this latest kind of dollar bounce after what it was 4-month repricing has actually taken it into a tactically rich area that might open up better entry levels for dollar downside. Very quickly, in terms of your point on where we are on the dollar smile and what's driving it, I guess the big debate at the moment is, are we still in the traditional kind of interest rate differential driven market? Is it Fed versus the BOJ or versus the ECB, or have capital flows become more important? And again, I'd happily take this conversation into more detail offline, but back to the treasury models and the use of QT expectations and the use of the money market strip, we have tried to preemptively cover this. So we have a variable in all our dollar G10 crosses, which is the 530s box between the two currencies. So that captures the curve shape, 530s for US versus 530s euros, 530s yen. And that's become a much, much bigger driver. And the pattern that you're seeing emerge quite strongly is that the steeper curve in the US is a headwind for the dollar. Or put another way, the Trump chaos premium that's forcing 30-year bond yields up towards 5%, that's a dollar headwind. And that is kind of a proxy on capital flows, we feel. It doesn't capture, flow data is at best weekly, more often monthly. It's typically lagging. It doesn't give you much granularity in Japan. There are a couple of big names that you want to know if they're driving the flow or not. Flow data doesn't really give you that. So having a daily proxy via curve shape and then that 530s box works quite well. But that's the kind of 10,000 feet on FX, and I'm happy to revisit offline.
Thanks, Hugh. I think we have time for maybe one more question, and it's a good one, I think, to end on. And it's from Alex Tempier, and he says, how do you use your indicators to assess confidence and conviction levels?
Hugh, I can jump in
I'm
here.
happy to take that one as well. But Jervis, I'd love to hear your thoughts as well, actually, as a practitioner, as opposed to a talking head. From my side, very quickly, model confidence. If you're going to use a macro signal, then you want macro to be doing a good job of explaining the variance of that particular asset price. So model confidence is an instant box that needs to be ticked. Then you want to overlay the valuation gap with what macro momentum is doing, i.e. what QI model value is doing, because it might well be that something is one standard deviation rich and QI is saying this is a potential bearish level. But if macro model value is moving higher, then what we're seeing is just actually the spot market has moved quicker. The market's been a more effective discounting mechanism and got there ahead of macro. So you want to cross-reference both the FVG, the fair value gap, with what underlying macro momentum is doing. And then we've got a few optimization techniques around that we've worked on, because we're very, very conscious. Having sat in your seats, we know signal doesn't equal P&L. There are additional steps required to turn that initial raw signal into something that's actionable, and we've got a few techniques for that. But Alex, I will reach out to you bilaterally to do that. And Jervis, if you wouldn't mind wrapping up.
Yeah, for sure. So just layering on to what Hugh mentioned, that you need to cross-reference certain different metrics, quantitative metrics within Quant Insight to begin. But additionally, what makes it really more powerful, and when I start to build conviction, is both qualitatively and the bottoms-up work that I do. When that aligns with what Quant Insight is also saying, just from a purely quantitative angle, that's when my conviction levels can really increase significantly, right? And this, apart from trading macro, I also trade single stocks. And for single stocks, again, same thing. Quant Insight can provide me a fair value gap. It can provide me the model confidence. It can provide me the momentum going on there. And if that aligns with my view of if you were, fundamental momentum in that business, that's sort of the best case scenario when all stars align.
Great. I think that is all the time that we have today. I know there were a few questions that we didn't have a chance to get to. We'll be sure to be in touch with those individuals for a direct follow-up from someone from Quant Insight or Macrobond. I want to take this time to give a special thank you to our panelists, Hugh and Jarvis. Your insights are truly very appreciated here. So thank you for that. And we want to thank everyone for joining. And have a good rest of your afternoon. Bye.